Why is securitization a core concept in shadow banking? Imagine a world where banks can turn their loans into tradable pieces of paper that investors can buy and sell. That's what securitization does, and it's a key part of how shadow banking operates. Shadow banking includes financial firms that do many banking-like activities but aren't regulated the same way traditional banks are. They handle credit and liquidity in ways that often stay outside official rules. Securitization is at the heart of this because it allows these firms to package loans like mortgages and personal loans into securities. These securities can then be sold to investors, spreading out the risk and freeing up capital for more lending. This process started as a way for regular banks to move loans off their balance sheets. By doing so, they could free up space to make more loans and manage risk better. Over time, shadow banks adopted securitization to do the same thing but on a larger scale. They created products like asset-backed commercial paper and collateralized debt obligations. These are structured finance tools that slice up the cash flows from pooled loans into different parts, called tranches. Each tranche has a different level of risk and return, appealing to different investors. Securitization helps shadow banks share risk by transferring it from the original lenders to a broad range of investors. It also helps them keep their regulatory capital low by turning long-term, risky loans into short-term, liquid securities. This means they can quickly raise cash to fund new loans or investments. Plus, securitization introduces some market discipline because third-party investors and rating agencies evaluate these securities, making the process more transparent. Another reason securitization is so important is that it allows shadow banks to do maturity transformation. They borrow short-term funds by issuing securities that are quick to sell, but the loans they fund are often long-term and less liquid. This setup is a hallmark of shadow banking, enabling quick funding for long-term projects. Before the financial crisis of 2007 to 2009, securitization helped fuel rapid growth and risk-taking outside traditional banks. It allowed shadow banks to operate with high leverage and less oversight, increasing systemic risk. This shows how securitization is not just a tool for efficiency but also a factor in financial stability. In essence, securitization is a core concept in shadow banking because it allows these institutions to create, distribute, and manage credit risks in ways that traditional banks cannot. It drives innovation in financial products but also introduces vulnerabilities that can ripple through the entire financial system.